Good afternoon, everyone. Happy holiday weekend. We're going to take a quick look here at the North American equity markets in terms of where they performed today, but really also on a weekly basis. And of course, over the quarter, we've just rounded out the first quarter, and the performance is really quite good. In terms of the past week performance for those U.S. markets, the Dow was up slightly. S&P was up by over 1%, the NASDAQ up by 2.6%, and the Russell 2000 up by 1.4%. Those two areas of the market, to me, are really quite important in terms of showing some resiliency and the fact that even though they've been under pressure, the NASDAQ tech shares as well as small cap companies, because of the increasing interest rate environment, that U.S. 10-year yield that we've talked so much about, putting downward pressure on valuations, that was not the case this week. And it almost seems as though you have to wonder if we aren't in a bit of a Goldilocks scenario where you've got the fiscal policy support as well as monetary policy support and the expectations that we will in fact see some very good, strong growth in the United States. Now, of course, that, when you take a look at the performance, whether it's a daily or weekly basis, you have to decide too where you want to be positioned in terms of having your overweights. We did see growth and momentum up by 2% and 3% respectively. So again, that goes back to that tech trade, which again did perform well this week, recouping some of the more recent losses. Value was down slightly this week, but of course that rotation trade into the cyclical value-oriented areas of the market has been a big theme, and many investors continue to believe that that will continue to work. That's kind of the reopening trade. And of course, what was supportive of that is continued optimism surrounding the vaccine rollout in the United States. We also had very positive economic data in the United States this week. Consumer confidence as well as the ISM numbers surged. The ISM manufacturing data was the best number we've seen since 1983. We also saw Facebook and Google perform very well this week, up by about 5% for both names, and Amazon up by 3.6%. Gold was down slightly on the week to the tune of 0.2%, and WTI was up by 0.8% on a weekly basis, but really gained some strength today, up by about 4%. In terms of news flow, now, of course, we heard from the White House and their infrastructure plan to the tune of spending $4 trillion to be paid for by increasing taxes to the tune of $3 trillion. We'll see if that gets passed, what the implications might be. And one of the most interesting news stories I've been thinking about over the past week was the forced family office, the selling that the family office, Archegos, had to go through because they are basically a $10 billion family office that used leverage maybe to the tune of 5 to 6%. So they had a forced selling that was really occurring last Friday into Monday, which surprised a lot of people, of course. The banks, Nomura as well as Credit Suisse, taking $2 billion to $3 to $4 billion hit respectively. Was so interesting about this really is that there was not a systemic risk associated with it in terms of all the selling pressure and the leverage that was in the market. But certainly some of the media names got hit quite hard because, and some of the China internet names, because that's where this family office had a lot of exposure, where they really leveraged themselves up. It's interesting, I suppose, as well, in the sense that the amount of leverage that can be out there, and using swaps and different types of derivative products that kind of mask some of that leverage that's in the system. So just beware. I've actually had a very in-depth conversation with somebody about that today, and I will have that out probably by the weekend. So stay tuned for that. And also, of course, the other big news this week was the container ship that was stuck in the Suez Canal, but has since been freed. So those were kind of some of the more interesting news items. As it relates to the Canadian market, the TSX showed some nice strength today, up by 1.6%, 1.3% to the upside for the week. And here in Canada, the TSX is up by 7.3% on a year-to-date basis. That does actually outperform the S&P, which is up by about 5% on a year-to-date basis. Materials and energy, two areas that did show some nice strength today. And the Canadian dollar did trade higher versus the US dollar. And of course, as I mentioned before, WTI up by close to 4%, certainly helpful for the TSX. Away from that, of course, on a news flow perspective, we did hear that Ontario is having a province-wide 28-day emergency break shutdown, that is, and Quebec is moving 2 regions into lockdown as well. Obviously, that's on the back of COVID-19 cases increasing, with some real showing that the variants are increasing as well. On that front, we've had news this week that AstraZeneca is not to be used in those 55 and younger. We also had positive news surrounding Pfizer that that they have 100% efficacy in adolescents. So a bit of a mix here in terms of the news. As it relates to economic data here in Canada, some nice showing as it relates to GDP this week, and also March manufacturing and building permits coming in a bit higher than expectations. Shopify was up by 4% today. That's on the analyst over at Wolf initiating coverage with an outperform. And away from that, as we look at the first quarter here in Canada, it was the biggest merger and acquisition activity in terms of dollars that we've seen ever. And that, of course, is attributable to Rogers making a bid for Shaw and CP making a bid for Kansas City Southern, the railroad. So some interesting movements there. Sometimes that bodes well when you see company managements deciding to put money to work. They've got to feel somewhat comfortable in order to do that. Have a great, safe, fun holiday long weekend, and stay tuned for that in-depth interview. I'll have a little bit more detail in terms of who it was and what we talked about. Very in-depth. See you later.